On July 22nd, Tesla did something it hasn't done in over a year. It grew. Revenue came in at $28.2 billion, nearly $3 billion ahead of what Wall Street expected. Record quarter, record deliveries, and within minutes of the numbers hitting, the stock fell. Because buried underneath the best top-line Tesla has posted in 18 months was a plan, a comeback plan. And that plan is the reason investors are nervous, not BYD. Start with the split. Revenue, $28.24 billion, beating consensus by 10.5%. Earnings per share, 33 cents, against roughly 50 cents expected. That's a 34% miss. Tesla sold more cars than it ever has in a second quarter. 480,126, up 25% year over year, and it made less money doing it. GIP operating income for the quarter, $400 million, on $28 billion in revenue. That's an operating margin of about 1.5%. Volkswagen runs higher than that. Here's where it gets uncomfortable. Automotive gross margin fell sequentially to 16.3%. Free cash flow went negative, roughly minus $1.1 billion for the quarter, and management didn't apologize for it. They guided capital expenditure above $25 billion for the full year. Read that again. Tesla is burning cash, compressing margins, and telling shareholders it intends to spend more. That is not a company defending its car business. That's a company that has quietly decided the car business is no longer the point. So what is the point? Energy. Tesla deployed 13.5 gigawatt hours of storage this quarter, up 53% from Q1. But the order book is the real story. Over $9 billion in new Megapack orders in a 6-week window. A $3 billion agreement with Ishisoft covering 15 gigawatt hours across the UK, Europe, the Gulf, and India. A NAT power deal targeting 100 gigawatt hours over 20 years. BYD cannot touch this. Grid-scale storage is a completely different business. The second wing is autonomy, and it's shakier. Tesla added 3 new robotaxi markets in Q2, taking it to 5 operating metros, with a target of at least 9 cities this year. But paid miles fell 36%. 8 months into the Austin launch, availability sat near 19%, inside a service area far smaller than what was promised. And in Q2, Tesla discontinued the Model S and the Model X entirely, to redirect manufacturing toward Optimus. Think about that as a signal. Tesla is killing 2 production cars to build a humanoid robot that currently generates. Meanwhile, BYD is doing something much more boring and much more dangerous. In the first half of 2026, BYD matched Tesla's European market share for the first time, 2.4% each. In February, BYD outregistered Tesla in Europe. 17,954 to 17,664, growing 162% year-on-year, while Tesla grew 11. The Hungary plant starts production in Q4. They're hunting a second European factory in the south, and the Dolphin G launches in Germany at 28,990 euros. No robots, no robotaxis, just cheaper cars built closer to the customer. And there's a detail in the margin line worth pausing on. Management attributed part of the sequential decline to one-off items in the prior quarter. Translation: Q1 looked better than it really was, which makes Q2 look worse than it really is. Strip the noise out and you get the same trend Tesla has been running for 6 quarters. More cars. Thinner margins. The volume is real, the profitability is not keeping up. But there's a catch inside the energy number too. Deployment surged 53%, and margins compressed while they did it. Tesla is buying share in grid storage the same way it bought share in cars. Volume first, profit later. For context, Tesla deployed 46.7 gigawatt hours across all of 2025. At this quarter's pace, it clears that inside a year. The scale is genuinely impressive. The economics are still unproven. And this isn't a European story alone. Across all of 2025, BYD sold 2 million, 256,000 battery electric vehicles. Tesla sold 1,636,000. That's a gap of 600,000 cars in a single year. In the UK, BYD is now the top-selling EV brand outright. Ahead of Tesla, ahead of Kia, ahead of Volkswagen. Boring, affordable, everywhere. So what actually decides this? Three things, and none of them are on the earnings slide. Whether energy margins recover as Megapack 3 ramps, whether robotaxi paid miles turn back up or keep sliding, and whether the Hungary plant ships on time in Q4. Get all three wrong, and $25 billion in capex starts looking like a very expensive bet. Get them right, and this quarter is the bottom. Now look at how the market is actually pricing this. Tesla stock is down 11% this month and 17% on the year. The Nasdaq over the same stretch is up. And in 2025, Tesla's profit fell 45% against the year before. This is not a market waiting patiently for robots. This is a market that has started to discount the promises and price the numbers. Now, to be fair, there is a real bull case here and it isn't stupid. Revenue just grew for the first time in over a year. FSD attach rates climbed sharply this quarter. Model Y demand is holding up, and Megapack is now operating in more than 65 countries, with an order book stretching into the 2030s. If you believe the energy division alone becomes an $18 billion business this year, then the car margins matter a lot less than they look right now. But here's the uncomfortable part. Every single one of those bull arguments requires you to look past the car business. And the car business is still the overwhelming majority of what Tesla actually is. You're being asked to value the company on the two divisions that currently lose money and quietly ignore the one that makes it. That isn't investing. That's faith. So here's the verdict. Tesla's comeback plan isn't a car. It's a bet that energy storage and autonomy arrive before the margin compression does permanent damage. Energy is real, growing, and defensible. Autonomy is late, expensive, and unproven. And while that bet plays out, BYD is taking Europe one affordable model at a time. The reason investors should be worried isn't that Tesla is losing to BYD. It's that Tesla has stopped trying to win that fight. If you want the full breakdown of how BYD got here, that video is on the channel right now. And subscribe because the next one covers what happens when the Hungary plant comes online.